All right, now on this segment of the Gray Report, a special guest, John Chapman, who is the summer intern here at Gray Capital, Ohio University student, but really has been kind of acting as our chief data scientist here at Gray Capital because we don't have any other data scientists primarily. But John, you've kind of stepped into a little bit different role than some of our past interns have, which a lot of times, helping out various aspects of the company, whether that's in property management or accounting or investor relations or asset management. You focused a little bit more on really some of the research side. Because at Gray Capital, we do publish regular research reports, analysis. A lot of times we're aggregating data in analysis elsewhere, consolidating it, and then providing our own analysis on top of it and putting these research briefs together. Some of the work that you've been doing through some of what you've been learning in school and then just doing on your own time has allowed you and us to dive a little bit deeper with some areas of statistical analysis. So first, just maybe can you give us just a little bit about your background and then just a little bit of generally what you've been doing here at Gray Capital this summer before we get into what your research is showing?
So I am currently finishing up a bachelor's in business economics at The Ohio State University. Just got a couple semesters left on that. I have a real interest in sort of the data and numbers side of things. I've always loved looking at a big spreadsheet. In regards to what I have been doing at Gray Capital this summer, it's been a lot of firstly getting acclimated to the kind of economic environment that multifamily inhabits. It's a little different than, I guess, like what someone might be doing if they're going into, something related to like stocks or finance. It's definitely has its own kind of unique sphere. With that being said, definitely spent the first part of the summer kind of getting acclimated to what that environment looks like and then putting into practice some of the things that I've learned at school and on my own in regards to statistical analysis, seeing what's the correlation between these two things. Is one, indicator a good indicator of another thing? How well does rent growth predict what future supply is going to look like? And so going on into the summer, I started to take a special focus on, can we predict or can we forecast what certain specific markets are going to look like for the sake of the business, but also just for the sake of getting more information out there. It can never hurt to have too many forecasts out in the world. And so getting into that, we started with a project that I worked on for a good bit of the summer, probably going into the start of June or so, where we took some very key economic indicators, variables, such as rent growth, job growth, supply growth, and vacancy, and plugged them into some more simple kind of forecasting models to say, what does the supply growth and rent growth in Indianapolis or in Columbus look like going into 2026? Just starting out very simple to get an idea. And we released that report, if I'm not mistaken, just a few weeks ago now.
Yeah, I think it's called Predicting the Future of Multifamily. And I'm curious to ask you about that report. And you can go to graycapitalllc.com right now and download a version of that report. Did anything surprise you, I guess, in terms of like which variables were more important, which were statistically significant, which weren't? Anything, I guess, surprise you from when you started that process to when you finished it?
Yeah, definitely. Historically, when talking about supply growth, for instance, or rent growth, something that has always been, I guess, closely looked at is like, what's the job growth looking like? But then you look at areas like Austin, for instance, which are seeing great job growth, but they're seeing negative rent growth. So we said, okay, so what's the other story going on here that isn't being told? And I looked into variables like vacancy, for instance, which showed that, despite the job growth still being great, vacancy was continuing to rise because the supply growth was outpacing the demand for it. So certainly, I was surprised to see the alternate side of the story that I guess wasn't really being talked about as much. I talked to quite a few experts in regards to, what variables did they historically use to predict supply and rent growth and such. Um, and definitely there was kind of this unknown kind of horizon getting out of COVID to say, how are we going to predict rent growth and such in this new economic landscape. So definitely it was a surprise getting to work with those variables and kind of discover on my own what that kind of new story looked like getting out of COVID.
What are some of the indicators, not, going to every single piece of your model, but what are some of the indicators, I guess, that you would say is primary of forecasting rent growth?
So definitely job growth is still very important. There's definitely markets that are dominated by lots of people moving in. And sometimes that doesn't even necessarily appear in the job growth data. A good example is some cities in Florida, which despite not having huge job growth are still seeing increased rent growth because they have lots of people moving in to retire. Yeah. Examples like that. Some more kind of sub-market specific examples. Vacancies, like I mentioned before, I think a really important one. I wouldn't say necessarily overlooked, but maybe people are starting to consider that it has maybe a little bit more of an effect than it previously did. You have markets that are seeing, rather record low vacancies, and they're seeing great rent growth. A good example is Kansas City, for instance. Not crazy low vacancies, especially in consideration to some other markets like Philadelphia, which is seeing very, very low vacancies. But like Kansas City, for instance, a decently low vacancy combined with a decently high job growth has led to just a really, really strong rent growth record. So I would say vacancy is one of those where if the gap is there, then it indicates that not enough people are moving in to sustain a good enough rent growth, whereas people were traditionally kind of relying on the job growth in of itself to tell that story. We're kind of maybe missing the second piece of it. Definitely some other indicators would be things like just population growth in general, especially when it comes to, larger kind of apartments, 2-bedroom, 3-bedroom, people moving in with families, stuff that isn't necessarily reflected by job growth data just because more people might be moving in than the job growth is indicating.
And so then, so you've got all these variables. How do you determine like the weighting of all these variables? What's like more impactful and, significant, statistically significant?
Yeah. So a lot of it can honestly be discovered just through doing some statistical testing. The easiest way, just for example, is a regression. We plot all the data out and we run a regression in a statistical software, and it says, all right, here's what, if you were to take 100% of this rent growth picture, here's what percentage that, job growth contributes to or vacancy contributes to. And depending on what kind of model you're using, that weighting will vary, especially if it's something like a time series where, you're using data, from each quarter to kind of build a story over time. The weighting can certainly change as we've seen coming out of COVID.
And then, but different markets also require a little bit different weighting. Also, you discovered.
Yeah, right. Definitely. Different markets kind of are telling different stories. I say almost they're kind of in a different phase of their life, going between undersupply to really strong rent growth, but growing supply to finally the supply overtaking that job growth. And as a result, the rent growth starting to decrease again. I would describe it to be pretty similar to kind of like a business cycle where you have, booms and busts, and it's always kind of flowing like a wave going up and down.
Got it. Okay, so focusing on rent growth, looking at some supply forecasting. Then you started looking at starts and permits, and not to fast forward too far ahead, but you were able to come up with a new way of attempting to predict the amount of starts, and it's by looking at the ratio, by forecasting the ratio between permits and starts, rather than just trying to forecast like the actual just discrete numbers themselves. Did I summarize that correctly?
Yeah. So basically, this came out of, and I don't know if you want to go ahead and talk about the kind of how this came about.
Go for it.
But This basically came out of a conversation that I had with chief economist at RealPage, Carl Whitaker. Had a great conversation with him, and it generated some, I guess, questions that were lingering in my mind. He had talked about, forecasting permits, forecasting starts, and then kind of settling into a ratio. And I'd kind of thought in my head at the time, without maybe a proper justification why, but later on discovering it, was that, why not just forecast the ratio itself? And so I looked into it, and I kind of thought about it some more, and I came to the justification that and it has been backed up by some data and analysis I've done, that just forecasting the starts without forecasting the ratio, you're sort of baking that ratio in, but the general kind of assumption that you're making is that the level of starts is going to be at least semi-independent of the level of permits, in the sense of it doesn't take into account the economic variables during that quarter where they decide to turn this permit into a start. For instance, you could have, let's say you have 80,000 permits from however many quarters ago.
Yeah.
And you go on now into the present. Previous models would say, okay, here is the 80,000 permits. We're going to give it an arbitrary lag of time to say this is how many quarters it's going to take to turn into a start. We are going to take the economic conditions, and then we're going to just plug it all in and say, okay, based on the economic conditions, based on the permits, here is how many starts. And so it's kind of assuming that a ratio is there, but not forecasting one directly. And so the reason that I decided on to try to look into forecasting the ratio directly was under the logic that, okay, we know the amount of permits. Instead of predicting what level of starts there might be, let's hold level of permits constant and just predict what percent of permits, regardless of how many permits they are, in this current quarter are going to turn into starts themselves. So previously it was very dependent on the level of permits, whereas now you could conceivably have any level of permits and still have a similar outcome of the ratio, and it would say this X percent of permits, regardless of the level of permits, is going to turn into starts.
And so you're looking more at macroeconomic factors to determine that ratio?
Yes.
Which economic factors are you looking at, and how do you choose those?
Yeah, so I mean, there's a million different variables that you could use to predict it. Some are used more commonly than others. Definitely, rent growth is one. Job growth, obviously, previous level of supply and permits are baked in a little bit. Although I will say that when I did some testing, I found that going into some lagged periods, the percentage that the current level of permits depends on the previous level of permits is actually not as high as people might think. We were seeing less than 10% of permits from this quarter were dependent on the level of permits from last quarter. So definitely diving into some of those more variables that are separated from the permits themselves. More examples are 30-year mortgages, 10-year treasury rates, pretty common stuff. But then looking into some more specific stuff as well, like construction cost indexes, the lumber cost index specifically was one that I felt was very interesting because many of these multifamily constructions are we do a floor of concrete and then 3 or 4 floors of lumber. So with lumber being a pretty important component of this, tracking, what is the price? Is there significant import prices coming? I know we import a lot of lumber from Canada. Is there a lot of import price that's putting pressure on the cost of construction? Just taking a look at all of that to see, when people decide to permit, they think it's economically viable in the future to build that said thing. But then when it comes to that future point, is it still economically viable to do so?
Have you gone back to see how the ratio has changed over time? Do you have enough data to be able to go back to see, I guess, the variability of the ratio itself?
Yeah. So the ratio has definitely been something that has fluctuated a lot, sometimes just due to noise and arbitrariness. I have data going as far back as like the 1960s. I would say maybe just like to highlight specifically what a good example would be. Um, like 2014 to 2025 is kind of a good example where in periods of economic recovery, where inflation isn't crazy, um, the ratio is generally closer to 100%. You're getting high
What's
80s, maybe low
permitted is being
90s.
built
Yeah.
eventually. Yeah.
And especially if you are increasing permits from one quarter to the next, typically the ratio is going to um, stay close to that 100%.
Yeah,
Whereas
sense.
if the permits decrease the next quarter, you'll probably see a little bit of a drop on the ratio. A good example is once COVID kind of hit, inflation happened to a lot of things. You saw a real widening of the ratio, getting sometimes even as low as into the 60%, where it's just, people set up permits maybe even before COVID, and then COVID hit, things got really crazy. And then we said, all right, it's no longer financially feasible to build. But what was interesting is that even then during COVID, post COVID, there was a very large amount of, permits, and there was a large amount of starts as well. It's just the percent of permits that turned into starts just was not like it had been prior to COVID.
So now, how about today, when not only do we have all of those economic indicators, we have like it's like a noisy environment, a lot of uncertainty, but then also, there's, and we talk about this in the Gray Report every week, there's a lack of equity financing for new developments, and it's where you could see. I could imagine that the ratio would be off less starts than are actually permitted. Has the noise helped kind of, I guess, develop the model, or is it more challenging to make use of it?
Um, I would say generally the noise has made it more challenging, um, just in the sense of like it's not as predictable as you would want it to be. For instance, permits and starts are way up this quarter. After we've seen quarter after quarter of decline. I think last quarter we were in the 80,000, 84,000, I believe it was, for starts. Now this quarter we're seeing 100,000 for the quarter.
Yeah. Yeah, Matt and I were just talking. A new Real Page report shows that a lot of markets that are already oversupplied are permitting, tens of thousands of units.
Yeah, and so there definitely has been a reversal, and it definitely it makes you wonder: is that reversal a trend or is it noise? And the issue with anybody doing any forecasting is that you have to, I wouldn't say necessarily make some assumptions, but you just have to you let the model do its thing, and it can say some really crazy things just based on that noise. For instance, if the model thinks that jump is a trend, then it's going to forecast that there's going to be a huge increase in permits just because it would expect it to keep going up. Yeah. Or if it thinks it's noise, then maybe the forecast is going to say that it's going to go down. Ultimately, there is still room for an economist to say, what do we believe is realistic for this situation? Do we believe that it's realistic that it's going to go up? If not, do we need to look at examining or tweaking the model? Or if we do believe it's realistic, then is there, precedent for that happening?
We've heard from some economists just on that, the recent kind of surge in new permits, that maybe it's more noise than real trend. Do you have an opinion one way or the other, or kind of an explanation of why we've seen a tick up?
Yeah, I think definitely they're like, if I were to say between noise and trend, I would be inclined to say, sure, we could have both. Although I would say maybe it's more noise than trend. If I had to guess, I would say we would probably see a decline, not a substantial decline, but a decline nonetheless in the next couple quarters, back into some a more flat area, probably around 90,000 to 100,000 starts per quarter, if not a little bit lower.
I think you were saying yesterday, it's just like most things don't usually go in an absolute straight line.
Yeah.
They can be declining and then a little bit of a surge up. And maybe this was, early positive sentiment, maybe of, tariffs being resolved,
Mhm.
maybe rates going down. And so a bunch of decisions were made. Equity was deployed in some of these developments. But it sounds like we're going to need to get another quarter of data, or at least a couple more
Yeah,
months.
I would say definitely. I mean, a quarter or two. I mean, when we're thinking about permits, it depending on how long it takes for a permit to go into a start, you're looking at multiple quarters even. Um, I would think about it sort of like generations. If a generation has a larger than normal set of births, for instance,
Mhm.
then the generation or a couple generations after them is going to also have a larger than normal set of births. It's kind of a jump and then a settling again, and then another maybe smaller jump.
Yeah.
So time will tell on how many of these permits turn into starts, although it's very based on how many starts we've already had this quarter. It could be assumed that probably a decent amount of them will, and that might spike up the data a little more.
So, I mean, what is the model showing? I mean, have you taken a look at with this new data of how many permits? I mean, how many permits are going to turn into starts? I mean, do you have an idea?
Yeah, so I can't speak too specifically on the proper forecasting, just because there is some more tuning that needs to be done
Yeah.
to the model. I can
Yeah,
say,
we want the numbers.
yeah,
We want it all now. But John, what do we invest in?
so I can say, and I just want to make sure I have the graph that I made in front of me. Um, I can say that probably going into next quarter, we will safely see a small decline uh, in starts. Like I said, probably around 90,000. Although I would say that the quarters after that, going into 2026 Q3 or Q4, you could probably see it go up to as high as 130,000 or so.
And so we haven't mentioned that, we haven't, I guess, said this yet. But what's interesting about, I guess, this method and why we're talking about it is that, from my understanding, my research, this is 37. This method of predicting starts by determining the ratio between starts and permits is 37% more accurate than just trying to predict the starts themselves of any known method that we use today.
Yeah. So basically, what I did was I trained the model, and then I had it forecast just starts directly. I had it forecast the ratio, and I had it forecast the level of permits. Then what I did was I took the level of starts and I took the level of starts from permits. So I took the permit level, multiplied it by the ratio, and then I got a level of starts from there. Compared them to historical data from 2014 to the most recent data in Q2 2025. And what I found was that the data or the start level from using the ratio was about 30% more accurate. There's been more tuning going on, just more adjustment, getting the more recent Q2 data, making changes to just tweaking the model to make it as accurate and honest as it can be. But it has repeatedly settled into about a 30% more accurate in regards to error against historical data. That comes from the mean average percentage error, which is basically you just have all of the errors. So, you have the actual amount of starts, you have your predicted amount of starts, the percentage difference between the two. You sum all those up and you take the average of them, and it says, on average, this is how far away we were from reality.
Yeah.
Taking those two, I found that with direct starts and the starts to ratio, it's settled into about 30% more accurate in regards to the predictions compared to reality.
Were you surprised that it was that much more accurate?
Yes, honestly, I was. Not just based on the 30% itself, but there's a statistical test called the Diebold-Mariano test
Yeah.
that you can use to test two different models against reality to see how accurate their predictions are, to say, is this model only slightly better? Is it just about equivalent, or is it significantly better? You're looking for a percentage value of 5 or less, meaning in all instances of this model, if if the result from the test is 5 or less, it means that in every instance that, or 95% of instances where this model is run, it performs better than the model that had, the model that is compared against. In this instance, it would be saying that the model using the ratio, it would be better than the model that just directly forecasts starts. And so ran that test. And what was interesting is that we got a percentage value of zero point 0.1 or 0.00111, which is a 0.11%. Basically meaning that there is very strong statistical evidence based on the testing that has been done so far in the data set that I'm working with to suggest that the model is not only better, but statistically significantly better, in the sense that if you were to run if you were to run the model 99.9% of times, it would outperform the historical model just performing or projecting and predicting starts directly.
Wow, that's incredible. Do you think, is there not, how do I say this? I mean, there's a lot of good economists that are in this industry looking at, maybe multifamily isn't as large as as the whole housing industry. I'm always surprised though. We've talked about this. For as large as housing is, it's more than 30% of making up of CPI. It's a huge percentage of GDP. So all those ancillary industries. There's not always the attention paid from economists compared to other industries or trying to just do other types of macroeconomic forecasting. Were you surprised, I guess, with maybe the lack of research and the fact that you've been here looking at housing now for this summer, right? That no one else has started looking at this method in the past. I was a little surprised. Not that I'm not a statistician. I'm not an economist. I often need to ask you to explain it to me, like I'm a 5-year-old. But I guess I don't know. You were surprised that no one has taken this method before,
Yeah.
or is it that is the technology, or are the processes you're using are new that haven't been around for a while? Or?
So, at least in the regards to like this method not being used before, I did I did perform a literature review on what had been done, and a lot of it had just been let's forecast starts directly. I can think of a couple reasons. One is just there might not be a lot of people doing this, but the other option can also be that more testing does need to be done to ensure that in all instances in data sets, does this model outperform forecasting starts directly. The margin of error is pretty good on this, but it could certainly be better in the sense of what the next step of this is going to be is let's take what data sets are other companies using to predict starts. I don't necessarily mean what model they're using, but what data set are they using? If we were to plug in their data set, because they might have some variables that might work a little better than what I selected. There's a million different variables that you could use to predict starts, and then the job of the economist is to say which variables do we feel are going to represent the story closely enough. So the challenge or the job going into the future, what needs to be done next is taking this list of variables that other groups have historically used, plugging them into the data and saying, does the model still hold up? At least thus far, from what I've seen, it has. But more testing can always be done. More validation can always be done. In regards to it not being used, so to, I guess, kind of sum that up in regards to why it hasn't really been done before, it could be said that the models that have been used historically probably work pretty well. And so with something that's ever fluctuating, like, the permits and starts where, 1 quarter or for the past 4 quarters, you've been declining permits and starts, and then all of a sudden you have a big jump. Many people can just say, this works good enough. We have a, 7% margin of error. We're going to take that. We're going to say, for our purposes, it's good. Yeah. For me, I just want to always believe that things can be just maybe even slightly better. Yeah. And so it's been exciting getting to work on all this. And the hope is to keep testing it with different variables to say, is this stacking up? Is there instances where it's not as good? What might cause those instances? To truly just be, as honest about everything as possible. I'm not trying to push anything saying like, oh, this is something revolutionary.
Yeah.
It's more efficient, but I also want to make sure that it is, as rigorous and honest as possible.
Yeah.
Don't want to ever,
So
sell something.
still relatively early stages, right? I mean, you came up with this relatively recently. You've been doing, a lot of work on it. Validation, more validation needs to be done, more testing, and we're going to continue to do that. But congratulations on
Thank you.
working on this, coming up with it. I mean, it's really exciting. How do you see this being used beyond just kind of predicting, I guess, what starts are going to look like? How can you imagine groups like Gray Capital or other groups, developers, kind of economists, using this information?
Yeah, so definitely, if you can get a good pulse on where starts and permits are heading, then you could definitely get a kind of good pulse on what your future, like for instance, what future vacancy is, assuming you have a decently good idea about where the job market is heading. For instance, we can know that like let's say a factory is opening, or like an Intel chip plant east of Columbus. We know that that's going to pull in a lot of people. What we don't know is, what's that going to do to rent growth? What's that going to do to vacancy? But if we can have a better pulse on what are our permits going to look like, what are our starts going to look like, to a degree of just maybe even 30% more accuracy, then we can say, all right, based on that, we can feed that in. We can feed the job growth in. We can feed a few other variables in and say, based on that, we think we might have a even more accurate idea on where rent growth or where vacancy is headed into the future.
Yeah, that's great. I find it interesting, housing, we've talked about, sometimes just there isn't as much data, and real estate investing historically has been, there's been a lot of intuition and a lot of back of the napkin analysis, and only until recently has it gotten much more sophisticated. Kind of the institutionalization of real estate and real estate investing, and I think we're still kind of at somewhat early innings of that process. But having this level of analysis and detail, I think, is really useful. Not just again for real estate investors and companies that are doing what Great Capital are doing, but also again economists and anyone who's trying to understand again the direction of travel for the economy by looking from a market by market standpoint and then extrapolating out. But it could be really interesting.
Yeah, definitely. I think there definitely is, especially in a sector like this, a very important place still for that, at least in my very limited experience, for that kind of back of the hand, or back of the napkin kind of analysis.
Yeah.
And the reason being is that, for instance, if machine learning, like what we're doing for this permits and starts and ratio forecasting, if machine learning was the end all be all, then everybody would be making millions of dollars on the stock market, for instance.
Perfect, right?
Like if it could perfectly predict the future, then we'd all be set. But it still has its own issues. It still has its own limitation. No matter what, even people say AI is going to take a lot of jobs or whatever. There is still going to have to be room, or there still will be room, especially in a market like this, for people who have expert knowledge on like a specific geographic location. If somebody knows a lot about the Columbus submarket or the Indianapolis submarket, that is oftentimes that knowledge on the market is going to, if not outperform, then go along very well with what is being predicted by the models.
Yeah.
Introducing that individual submarket knowledge is still going to be into the future a very important component of getting a pulse on what the market will look like in the future.
Yeah. No, I think that makes sense. I think there'll always be room for both some empirical evidence, but then also a little bit of just experience, kind of gut reaction feeling, and just kind of just knowing information that might not be inside some of those models also. Um, so I guess what's next in terms of of what's like your next question related to housing statistical analysis? What's that next question that's kind of been kind of tumbling around, and the next thing you want to kind of look into if you have something?
Yeah, I mean, aside from just like validating uh, this model and checking it with other people's variables, I would definitely like to look into better ways of predicting what the demand side of things is going to look like. I heard some very interesting things about school enrollment, for instance, to get a better pulse on, just general population coming in aside from just purely job growth. It's one thing for jobs to be growing, but are these people moving in to move into a one-bedroom apartment, or are they moving in to move into a three-bedroom apartment with a family?
Yeah.
Definitely getting a better pulse on what the demand side things look like. Like I mentioned earlier, like even like there's Florida submarkets where the job growth just isn't there, but the consumer spending is, because everybody who's moving in is, settling down to retire. They've got quite a bit, saved up that they can just, spend on whatever aside from like rent and everything. Um, and so exploring how the different facets of different local economies can be used to predict that demand in a way that maybe job growth just by itself doesn't reflect.
Yeah. Yeah, no, it makes sense. I think a lot of people are learning right now that, if you look at just one variable or just a set of variables, they can be misleading. It doesn't mean that they're, if jobs are coming to a market, that doesn't necessarily mean it's a bad thing, but it's not necessarily the whole picture. Because like you said, there's markets with strong population growth, strong job growth, but they have negative rent growth. And then some markets that maybe don't have as great of job growth, but the rent growth is positive because there's enough people moving in, retiring for different reasons. So there's a lot of nuance, a lot of subtlety that easily is lost when you zoom out. But it's fascinating.
Yeah, definitely. I think Columbus is a great example. I worked. Columbus was. I love talking about it. It's where
Yeah.
I'm from nearby, but also it's a very interesting kind of market because in the past few years it's seen a lot of job growth come in. Yet rent growth as of this quarter is actually a lot lower than it's been recently. And so looking into why is that the case? Oh, vacancies are on the rise. Supply growth is great, and rent growth still is positive.
Would you have thought rent growth was so, maybe not negative, but like if you hadn't been here working here this summer, I'm just curious of what your perception of rent growth would have been.
Had I not worked here this summer, I honestly probably would have thought rent growth in Columbus was insane. And the reason why was because the area where I live is close by to where they're building the big Intel plant.
Yeah.
And seeing people getting out of high school, moving into apartments nearby there, you were looking at $300 a month jump in rent from just a year ago. You know, just insane jumps. And these aren't necessarily like the fanciest buildings either. These are buildings that were built in the 80s, built in the
Luxury
70s.
apart now all of a sudden luxury apartments with new granite countertops, and
Yeah,
we've seen
and
that before.
I mean, I lived east of where the Intel plant was
Okay.
being built, but the same amount of the same mileage to the west, you got Columbus, and so like I would assumed it would have been very similar. Um, but then you look kind of more into the construction side of things, and you see, okay, well, I mean, turns out Columbus has a decent amount of room, especially on the east side, near the New Albany area, near the Pataskla area, to keep building out, to keep building multifamily kind of places, and they've definitely built a lot of that as lots of people have moved in, to the extent of outpacing the job growth that's coming in. And if I could just speak on it again, or speak on it just a little bit longer,
Yeah.
about my, I guess, kind of personal theory,
Yeah.
and to give credence to the idea of like individual economic conditions.
This is combining the real world experience, the gut reaction, to also the empirical data.
Yeah.
So please.
If I were to give, I guess, my own thought about why that's the case is, the Intel plant has already been delayed for quite a bit. It's supposed to open, delayed. Supposed to open, delayed. And so you have people moving in and that creates the job growth, that creates the population growth, with the expectation that those jobs are going to be there. Now we're A couple of years down the line, the jobs still aren't there yet. Sure, the construction jobs are. Sure, maybe there's kind of some secondary jobs that are popping up, but like let's say the Intel plant specifically, the jobs aren't there. Um, and so people are kind of, maybe there's more people who are planning on moving in and they're saying, okay, we're holding off. Or maybe the wave has already gotten there where everybody who is going to move in, or a large majority of it, them have. And the developers kind of expected that that wave would be a little bit bigger.
Yeah. Well, then there can be the pullback because then is this ever actually going to happen? And we had such high hopes, they didn't materialize. And so now we kind of have the opposite reaction.
And I think definitely there is a desire for local government, for people in the area to, I wouldn't say necessarily oversell the idea, but they're talking about billions of dollars of economic development. Sure, there are billions of dollars of economic development. What is the actual number of jobs that's turning into?
Yeah.
I mean, the data itself is pretty good to say, okay, there's a good amount of jobs being created, but does that amount of jobs actually translate into, billions of dollars if it was all, factory versus, lots of machinery doing the manufacturing itself? And so just that turning into an actual concrete number of jobs, it could have been that the developers and the local government sort of overestimated
No,
that.
no, a big public-private partnership that kind of oversold things a little bit. Never had that before. Up in Wisconsin, I know they've got the Foxconn plant. I think they're still waiting for those jobs to come online. That was, I think, however many, a decade plus. But it makes the headlines when you throw a billion or several $billion behind something and thousands of jobs. And because people are, they're selling it. They're selling it to the state because there's incentives that are involved, and they're trying to bring home a win for the state. But how that actually materializes isn't as always as clear, and it certainly doesn't happen as quick as everybody wants it to. Like right after that announcement. I've just got a couple more questions for you, not necessarily related to the work you've been doing, but because you're a man, and we were just having a conversation talking about home buyers, renters, and Gen Z, Gen Alpha. You're Gen Z, right? You're Gen Z. So, and you never want to paint one generation with a broad brush. I mean, millennials. I'm a millennial, and so we get put into a certain category of like avocado toast memes or whatever disparaging meme you come up with. Gen Z. There's the same type. I find that you don't necessarily toe the line of all the Gen Z kind of memes or stereotypes, but you're an RA in college, so you're experiencing and you're interacting with a lot of people your age. Question is on buying a home. There's an amount of risk tolerance that's involved to go out and buy a house. You have the money to do it. You have to take a little bit of leap of faith. Say, I'm going to put that down payment down. I'm going to lock in. It seems like there is this idea of like the housing market could crash at any time. The question is, do you think Gen Z is going to have the risk tolerance to buy homes when if they can afford it? Do they have the risk tolerance to do it, or are they going to prefer to continue to rent?
I think generally, let's assume for a second there isn't a crash.
Yeah.
Many of the people who are going to be able to afford a home at, let's say $300,000 will probably also be able to afford that home if it's at 325. In terms of elasticity, meaning people being willing to buy at a given price, it seems like in regards to Gen Z, the people who are going to be able to afford it probably will, assuming the price doesn't get too insanely high, assuming there isn't a crash. I would say in terms of risk tolerance, definitely that is going to be a very small segment of Gen Z. I mean, you're looking at wages coming in of Gen Z coming out of college for graduating class of 2021, 2022, all the way up now. We're soon when I graduate in 2026, and looking at like employment, looking at wage figures. There are some people, let's say computer engineers working with AI.
Yeah.
People working in finance, people working in accounting, different sectors. Sure, there are people who are making great money, but it seems to be a lot of the case more of the exception rather than the norm. So if we look at how that would translate to the housing market in regards to risk tolerance, I think there's a lot of Gen Z who are under the vibe that they are going to hold their breath and hope that a housing crash
Like a
happens.
believe it. Yeah. So like
Yeah.
believe it when I see it. And the only way I'm going to be able to own a house is if the housing market crashes and I can get in at that point.
Yeah, I mean, I don't think that's necessarily a irrational thing to do. It's just housing prices can only go so high before they get a certain amount of standard deviations over what would be an expected rate of growth. This stock market's in a very similar place where it's reached now over two standard deviations in a kind of a similar place where it was pre .com bubble crash, pre other financial crashes, and so I'm not going to make any claims about whether a housing market crash
I was going to say, it sounds
is
like
going to
you're getting ready to
happen,
make a claim.
but certainly you see a
prediction.
lot of Gen Z hearing the news, seeing content online, on TikTok, on Instagram, saying about how unaffordable houses are. And so I think in many people's minds, they say, well, I can't afford one anyways. So I'm just going to rent for now and let's see what happens.
Got it. Yeah. Wait for the crash. Do you think that my assessment of Gen Z being maybe less risk tolerant is correct or incorrect?
Um, from what I know, I won't come to be an expert on like demographic stuff. From what I know, though, more Gen Z seem to be taking interest in stuff like investing, which typically takes a little bit more risk tolerance than just putting in your money in a high yield savings account or just leaving it in your checking account. Lots of Gen Z are looking into investing, into crypto, into different ways to maximize their assets while they are unable to build equity in other ways, like owning a home.
Is that because it's fun? Is it because you see is like FOMO, you see someone else doing it, or is it because I have to do this? My only other option is I'm gonna, work at retail. I'm gonna be a wage slave forever, and the only way out of this is I need to make some investments and swing for the fences and hit one. What do I have to lose?
I think there definitely has been two different narratives, specifically in regards to what is being consumed online. The first narrative is you can make millions of dollars on the stock market. You just got to buy into this crypto coin, or you just got to buy in to this stock, and it's somehow going to explode 100% overnight. I think there definitely is that vibe, if I just say, going on online, where there's lots of kind of influencers saying, you can be rich like me, you can have this Lamborghini, you can be able to afford everything that you can't because the economy is in a struggling place. Selling kind of selling a sense of hope more than anything else that these people or that these Gen Z will be able to afford what is becoming very unaffordable. And then there is the secondary set of media that is being consumed, which is that, we can't afford a house. We're going to have to rent. How can we make the best of a bad situation? They're definitely, like, I think all in all, despite the fact that there is lots of, I would say, get rich quick kind of information being posted online, on the whole, financial literacy has been on the rise.
I think that is definitely a benefit from all of the, even though the finance the gurus out there, which some of them are predatory. Some of them, there's a lot of grifting going on for sure. But if there's also a lot of people being aware and are getting an interest in financing and investing, and whether it was a meme coin that like made someone aware of what finances are and what securities are, and it sparked that interest and got them into it. It kind of doesn't matter what the entry point is. The fact we're going from almost no level of financial, education to at least being aware, and then the opportunity to go down a road and take a deep dive into personal finance, investing, because all that information is out there, whether it's free on YouTube or, you go to the library and read a book, or you buy, somebody's course that may be legitimate or maybe not. But that is interesting. And just the financial, regardless of what you think, about Gen Zs, and I think millennials probably split in half. Some are too far gone. Some I think probably are more interested because they have to be. They have to figure it out. But really, kind of your generation and then the next generation also are kind of growing up, being immersed in this environment. So I think that you would think that would be a net positive for society. And then even like longer term, we're talking about generations. Think about how we whether we manage our businesses or our institutions, or even the government. Are we? This is the optimist in me. It's like, do we have hope down in the future that we're going to have generation of leaders that are more financially aware? Would be a benefit to us all.
Yeah, I think it definitely depends on, you know, I think definitely the media that is being produced is a results or is a pulse on the greater state of like the economy, for
Mm-hmm.
instance. A lot of this kind of stuff is being produced because, or the conditions in which this media is being produced are a result of housing being unaffordable, lots of different consumer staples being unaffordable, different parts, really components of the American dream that many people were sold and still want to believe in are just becoming out of reach. And I think there is a certain resiliency in Gen Z, whereas there are definitely people who want to get rich quick. I guess maybe it's the optimist in me too, where there is a certain resiliency I've seen in many people, and I've seen many people on the other extreme as well, where people kind of feel very hopeless about the
Yeah.
situation. I've also seen a good amount of people who feel very resilient about, I'm going to do all that I can to reach as far as I can to achieve this. And I'm also going to hope the housing market's going to crash.
Yeah. Well, can't have our cake and eat it too, but we can all hope for it all. But John, thank you for coming on and doing this. Thank you for all your work you've been doing at Great Capital. We're looking forward to a lot more awesome work. And again, this new model is exciting. Looking forward just to see how new iterations as you continue to test it, tweak it, improve it. If you want to follow along though, for these types of reports, future reports, make sure you're subscribed to the Great Capital YouTube channel, but also greatcapitalllc.com is where we are going to be posting these research reports that John, Matt, Bosnagel, and the rest of the team are going to be working on. So again, thanks again. This is awesome work. And yeah,
Glad
thanks
to
for
be
being
on.
here. Awesome.